So what's happening with the GameStop stock? Here's a little 101. Let's start it off with Redditor Muroid. Short selling involves borrowing a stock from someone who owns it with the promise to return it at a later date and pay a small fee based on the value of the stock. You then sell the stock, wait for the price to drop, and buy it back at a cheaper price. And then you return the stock to the original owner and pocket the difference. This allows people to make money off a drop in the price of a stock. Unlike with regular stock trading, however, the potential losses of you are not limited. So if you buy a $10 share in a company and the company goes bankrupt, you lose $10. If you short a company with a $10 share price and that price jumps to $100 per share, you just lost $90. Since the start of the pandemic, GameStop has clearly been struggling in a big way. Such a big way that a lot of people, including major hedge funds, decided to short GameStop a lot. Let's say I own a share of GameStop stock and you want to short it. I lend you my share and you sell it. Now someone else wants to short the stock as well, and they borrow the share from the person you sold it to and then they sell it, and so on. If this happens enough times, you can have more people who owe back a share to the original owner than there are actual shares of the stock. This happened to GameStop, which had 140% of its shares sold short. This presents a problem for short sellers if the price of the stock starts going up instead of down, because there aren't enough shares to go around if they decide they all need to cut their losses and buy back the shares they owe at once. Some smaller investors, including those at Wall Street Bets, noticed this happening to GameStop stock and decided to take advantage. They bought up a bunch of shares themselves, driving up the price and further limiting the availability of shares. This caused some short sellers to pull out, which drove the price further up, which caused more short sellers to pull out, and so on. Meanwhile, the attention brought to this story and the quickly rising share of the price of the share caused more people to buy the stock in the hope of taking advantage of the meteoric rise in price to make money themselves. Back in the summer, you could buy a share for $4 a piece. Yesterday, those same shares were $147. Today, they're $345. The big hedge funds that were selling the stock short are currently literally billions in the hole, while the smaller investors are making money hand over fist. That all said, GameStop is still a struggling company underneath it all. It is nowhere near as valuable as its current share price, which means that eventually the bubble is going to burst and the price is going to come crashing back down. Anyone who buys in at the top, expecting to keep shooting up, is going to lose a ton of money. Anyone still shorting it at that time is going to make a ton of money. And anyone who bought it early and sells before it pops is going to make a ton of money. It's not clear whether the hedge funds are going to wind up actually losing billions in the end, or if they can recoup some of that when the bubble bursts. They may or may not come out okay, but there are definitely going to be a bunch of people currently riding the hype train who lose whatever they invest at this point. So, let's talk about it a different way, okay? And if it makes sense and you think about it from a tangible view, like say you borrow your friend's rare limited edition sneakers and sell them for $500. The next day, the sneaker company says, due to high demand, these limited edition sneakers are back in stock everywhere. Since they're no longer rare, the price has dropped significantly. So you buy them for $100, return them to your friend, and pocket the $400 difference. But say instead, the sneaker warehouse has a fire and most of the inventory goes up in flames. Now the sneakers are even more rare and the price goes up to $800. To be able to return the sneakers to your friend, you have to pay the original $500 plus an additional $300 to get those sneakers. So that's all regular short selling. What has happened different this time is Robinhood's transactions are done through Citadel. Citadel has backed Melvin Capital to the tune of $2.7 billion. Melvin Capital lost a fortune over $3 billion in this revolt because they had shorted GameStop. The more GameStop goes up, the more money they lose. So Citadel or Robinhood, banned their hundreds of thousands of users from buying shares of GameStop. But they didn't freeze the stock. They continued to allow users to sell the shares, just not buy any. The result was that the stock tanked. In the short term, it's now back up. It was blatant and overt market manipulation by a company who controls stock purchases in order to protect their own investments. Now Wall Street is pissed because regular people had the audacity to pool their money and use it in the same way these billionaires do every day of the week to influence the markets to their own advantage. This isn't a free market economy, it's a rigged oligarchy masquerading as a free market economy. So all in all, that is what is being talked about on Reddit this past week.